After a global tech outage from a Microsoft update took the world by storm, CrowdStrike went from $390 down to $250 in only a couple of weeks. After this 36% drop, is CrowdStrike set to drop further, or is this a perfect opportunity to buy this tech superstar on the cheap? Let's dive in and find out. 3 points that we're going to cover in this video. Number 1, company update / background and business model. Founded in 2011, CrowdStrike reinvented cybersecurity for the cloud era. With its AI-native Falcon XDR platform, CrowdStrike created the first true cloud-native platform built with artificial intelligence at the core, capable of harnessing vast amounts of security data to deliver solutions through a single agent. Part number 2, the opportunity, positives and negatives. So obviously we need to talk about the elephant in the room, which is the recent global tech outage affecting everything from airlines to governments. This was an absolute dumpster fire. Some of the world's largest enterprises, government organizations, and high-profile brands do trust CrowdStrike to protect their business. As of January 31st, 2024, the company had 29,000 subscription customers worldwide. Part 3, valuation. On Wall Street, we built 3-statement financial models culminating in a discounted cash flow valuation. I've built a 3-statement model with a DCF for CrowdStrike, and I can't wait to give you all the details. So let's dive right in. If you're enjoying this, please smash that like button. Okay, part number 1, background / business model. Company background. CrowdStrike was founded in 2011 by George Kurtz, who was the former chief technology officer at McAfee. He's the current CEO of the company. The headquarters for CrowdStrike are Sunnyvale, California, which is right in the heart of Silicon Valley. The industry in which they operate is the cybersecurity industry, which involves protecting computers, networks, and data from unauthorized access or attacks. The company mission is to stop breaches and protect customers from cyber threats. CrowdStrike aims to provide the best possible security solutions to keep businesses and individuals safe online. Business model, how do they make money? So this is a cloud-based platform. The Falcon platform operates in the cloud. It doesn't require customers to have special hardware or software installed on their computers. The good news is this provides real-time protection. It continuously monitors for suspicious activity and stops potential threats before they can cause harm. And ease of use. Being cloud-based makes it easier for customers to use and manage, as updates and improvements are handled by CrowdStrike seamlessly. All right, the revenue breakdown. 94% of revenues are subscription services. So CrowdStrike offers its cybersecurity solutions through a subscription model. This includes regular payments. Customers are paying a recurring fee, either monthly or annually, to access CrowdStrike services. And the Falcon platform, which is a cloud-based system that detects and prevents cyber threats in real time. The other 6% of revenues comes from professional services. So CrowdStrike also offers specialized services to help organizations when they are under attack or need extra protection. This includes incident response, where they provide immediate assistance to companies experiencing cyber attack, helping to mitigate damage and restore security, as well as threat hunting. Experts are going to be proactively searching for threats that might have bypassed regular defenses, ensuring higher levels of security. The geographic breakdown of revenues. For 2023, the United States was 68% of revenues, EMEA, or Europe, Middle East, and Africa, was 15% of revenues, Asia Pacific 10%, and other 7%. Now, CrowdStrike grew its subscription base by about 6,000 customers from 23,000 to 29,000 over the course of 2023, representing a 26% increase. And a tremendous positive, there were no channel partners or direct customers that represented 10% or more of the company's accounts receivables or total revenue as of the year end. Okay, part number 2, the opportunity, positives and negatives. Obviously, I like hearing the bad news first. So let's hit the negatives. The elephant in the room, and the main reason that we're even looking at this company, is due to the global tech outage that occurred on Friday, July 19th. The outage was caused by an issue related to CrowdStrike's integration with a Microsoft update. There was a conflict between the update and CrowdStrike's Falcon platform, and that's when all holy hell broke loose. So I was actually working at a banking client of mine in Midtown Manhattan, and people had to be manually let through the security turnstiles, and employees couldn't access their servers, their emails, or anything. 8.5 million Windows devices were impacted worldwide. Many people faced the infamous blue screen of death on their computers and were unable to log into anything. Flights were grounded, governments came to a standstill, and insurer Parametrics estimates that Fortune 500 companies face an estimated $5.4 billion in losses. And CEO George Kurtz has been sent a letter to testify on the outage to the U.S. House of Representatives Homeland Security Committee. Now, the stock has gone from an intraday high of 398 on July 9th to 12 trading days later, hovering around 250 on July 25th. That's a 37% drop. Now, while this appears to be an absolute dumpster fire, there are some silver linings, which we will cover next in the positives. More negatives. So, the last insider purchase was 19 months ago on January 5th, 2023, for $99. Since then, insiders have sold 1.6 million shares for $376 million at an average price of $237 per share. Now, this is an obvious red flag / negative sign, especially if you think the stock is undervalued. Now, I will be on the lookout to see if insiders buy over the next several weeks in response to the stock fall and the tech outage. Another negative, being a high growth tech company with a beta greater than 1, the stock can be volatile. As we've seen with the global tech outage, 20 to 40% drop in a short time frame is something to prepare for as an investor. Also, this is a highly competitive area. So the cybersecurity market is super competitive. You have old school players like Symantec, McAfee, Cisco, and Microsoft, as well as new school players like Palo Alto, Fortinet, and Checkpoint Software. Now, there are operational risks. As a cybersecurity company, they face constant threats and need to stay ahead of hackers. Cyber threats are always changing, requiring continuous innovation and adaptation. Also, double-edged sword here, dependence on subscriptions. Since their main revenue comes from subscriptions, any decrease in customer retention could impact their financial performance. And the churn rate, if customers decide to cancel their subscriptions, it could negatively affect revenue. All right, the positives. So the global tech outage, it was not a security issue or a cyber attack. That would have reflected poorly from a reputational perspective. As of Friday, July 26, 1 week after the outage, the CrowdStrike CEO said 97% of Windows sensors were back online. Now, in terms of equity research analysts, laser focused in on this, JP Morgan said CrowdStrike is delivering a masterclass on incident response. UBS said that the short-term pain is priced in and there's room for upside. And then Morgan Stanley said their partner checks indicated limited churn risk thus far.
But the Morgan Stanley note does talk about fueling the floor. Bottom line, we are slightly more constructive on Crowd.
Yeah, there's something.
Well, look at that.
More
they maintained a buy rating on the stock, lowering their price target to $360 from $396, which is still 39% upside. The analyst said, quote, longer term, we are slightly more confident CrowdStrike can limit reputational damage given a swift response and encouraging partner feedback. Other positives. Only 3.7% of the shares are short, which is a very low percentage. Also, another huge positive, CEO George Kurtz is the third largest shareholder behind Vanguard and BlackRock. He owns 3.2% of the shares out for a total of 7.82 million shares for a value of a little bit more than $2 billion. He personally lost $1.09 billion from the high to today, so he felt it. We love to see a CEO with skin in the game. Think Warren Buffett, Jeff Bezos, Elon Musk, and Mark Zuckerberg. Okay, innovative technology. The company's cloud-based Falcon platform is considered one of the best in the industries. It has advanced features using artificial intelligence and machine learning to detect and stop threats. And being cloud-based, it can provide real-time protection and updates. Also, high customer satisfaction. CrowdStrike is highly regarded for its customer service and its effectiveness, leading to high customer retention rates. The company has received numerous awards and recognitions for its advanced threat protection and response capabilities. Market leadership. CrowdStrike is recognized as a market leader in the cybersecurity industry, holding approximately 7 to 10% of the global market share in cybersecurity services. Strategic advantages. So CrowdStrike's cloud-native approach gives it a significant advantage in terms of scalability, flexibility, and real-time threat detection. The use of AI and machine learning enhances their threat detection capabilities, setting them apart from many competitors. Also, their proactive approach to identifying and mitigating threats before they can cause damage is highly valued by customers. Now, the next part is one of the coolest things I saw in this entire analysis of CrowdStrike: strategic investments. So CrowdStrike has a venture capital arm like many other successful tech companies. We're going to see this specifically next in the valuation. In 2019, CrowdStrike started the Falcon Fund 1 with an investment of $10 million. And in 2021, they backed it up with CrowdStrike's Falcon Fund 2 and an investment of $15 million. Now, the purpose is CrowdStrike makes strategic investments to enhance its technology, expand its capabilities, and stay ahead of the competition. The objective of the fund is to invest in early-stage startups and innovative companies in the cybersecurity space. Now, many other tech companies have similar investment arms to foster innovation, expand their capabilities, and maintain a competitive edge. This includes Google or Alphabet with Google Ventures. They invest in a wide range of industries, including technology, healthcare, and transportation. Intel via Intel Capital, they focus on investments in technology startups that align with Intel's strategic objectives. Microsoft, M12, formerly Microsoft Ventures, invests in early stage companies in areas such as artificial intelligence, cloud computing, and cybersecurity. Salesforce has Salesforce Ventures that invests in cloud computing and enterprise technology startups. And lastly, Cisco, through Cisco Investments, focuses on strategic investments in startups that align with Cisco's business areas such as networking security and IoT, or the Internet of Things. All right, part 3, valuation, the moment we've all been waiting for. So starting out the balance sheet, cash has increased 38x over the last 5 years, going from 88 million to 3.5 billion. And it is projected to more than 4x from here to get to almost 14 billion in 2028. Remember, not only is this software as a service, but it is also cloud-based, so there's no inventory. The company has done an incredible job managing its cost of revenue. We're going to see this next in the income statement. Strategic investments, which we mentioned earlier, the venture capital piece of 56 million, is a massive option for the company right there. And CrowdStrike has very little debt, just under 750 million at a 3% annual coupon, and it doesn't come due until 2029. On top of that, the company is net cash, which means cash is greater than debt by $2.6 billion. Lastly, retained earnings saw an inflection point in 2023, where it began to increase rather than decrease due to the company finally generating positive net income. So what's the takeaway? The company has a very clean balance sheet with rapidly growing cash balance that can be deployed into making capital expenditures, acquisitions, or even contributing more capital to their internal VC fund. So they have plenty of great options. Let's hop in the model. All right, y'all. So as we mentioned, cash and cash equivalents increasing 38x over the last 5 years. Absolutely incredible. We can see CrowdStrike's start of this strategic investments, this venture capital arm. Pretty exciting stuff here. Debt, super low, massively net cash. And another thing to note, while retained earnings was getting more negative, there's an inflection point right here in 2023, which is awesome for us to see. All right, next, the income statement. Revenues have increased over 12x in the last 5 years, going from 250 million to over 3 billion. This equates to a 5-year compound annual growth rate of 65%. That's insane. Gross profit, which is revenue minus the cost of revenue to generate those revenues, has increased substantially, with gross margin expanding over 20% in the last 7 years, going from 57% in 2017 to 77.3% in 2023. This shows that the company is managing costs effectively as it grows rapidly. Now, 2023 was a huge year for the company because they became EBITDA positive for the first time. Also, the company was able to generate positive net income for the first time, primarily due to almost 150 million of interest income being generated. This is due to the cash that they are investing in marketable securities. We're going to see this next in the cash flow statement. So what's the takeaway? CrowdStrike is really beginning to hit its stride with positive EBITDA and net income for the first time in company history, and high double-digit top-line growth. The company is really demonstrating tremendous results. Let's hop in the model. All right, so as we could see, eye-popping revenue growth, 12.2x over the last 5 years. That works out to a year-over-year increase of 65%. We can see the massive expansion in gross profit, which means that they're able to pass their costs on. Also, positive EBITDA, which is fantastic. This one's a really exciting piece. They're actually generating so much interest income off of their cash balance that it's caused their net income to be positive for the first time ever. All right, next we have the cash flow statement. After turning positive 4 years ago, free cash flow has increased over 50 times over the last 4 years, primarily driven by deferred revenue. Now, deferred revenue is a double-edged sword because it's where a client has been paid, but they have yet to receive the service. Like many Mag 7 tech companies, CrowdStrike is investing its massive cash balance into marketable securities consisting of highly liquid investments such as U.S. Treasury securities, commercial paper, and repurchase agreements. Over the last 7 years, CrowdStrike has generated over 1.4 billion from these investments. There are no scheduled debt repayments over the next 5 years because the only debt the company has, the 3% senior notes, don't come due until 2029. One final thing to note. Equity issuance. The company IPO'd in 2019, so why do we see further equity issuance from 2020 to 2023? These are proceeds from the exercise of stock options as well as the employee stock purchase plan. So what's the takeaway? CrowdStrike is a solid and consistent generator of free cash flow and is projected to generate over 10.5 billion of cash over the next 5 years. This massive cash stockpile will give it ability to not only reinvest in growth, but also make transformational acquisitions. Let's hop in the model. Free cash flow, which we're defining as operating cash flow less CapEx, 50.1 increase over the last 4 years. Absolutely tremendous. Again, that's being driven primarily right here by deferred revenue. Also, you can see the money that they're making off of the cash that gets invested is really, really helping out. Lastly, we see debt repayment of 0. It doesn't come due until 2029. And then the equity issuance that we talked about as well. Next, forecast drivers and DCF assumptions. The company projects 3.98 to 4.01 billion in revenues in 2024. That's 30 to 31% top line growth. So we ran the base case at the lower end of 30%. The company has done an outstanding job managing its costs despite rapid growth. Case in point, sales and marketing, research and development, and general administrative combined were 99% of sales in 2019. Guidance for 2024 is 48 to 60%. That is a total absolute reduction of 40 to 50%, which is mind-boggling in such a short time frame. For a high-growth cybersecurity company, they have a reasonable beta of 1.15, which is risky, but not what I would consider high risk. Also, something to note, the terminal multiple of 9.5 times LTM EBITDA is in line with the comps average and well below the historical levels for the company. Just be mindful. This is almost half of the company's current TEV to revenue multiple of 18.1 times. We're going to see this next in the DCF valuation. So what's the takeaway? Conservative assumptions are going to give us conservative results. Let's hop in the model. Forecast drivers and DCF assumptions. We see 30% top line growth here. Real key, if you look at the different scenarios, we're going based off of the company guidance. The company gave us guidance. You're always going to go with that because whatever the company tells to the market is what the market is going to judge them on. DCF assumptions, 5-year risk-free rate, 4.07, beta of 1.15. We end up getting a cost of equity of 8.6%. Post-tax cost of debt, about 4.5%. Massive amount of equity relative to debt gives us a WACC of about 8.6%. Also, they have cash currently, as of the most recent quarter, of $3.7 billion. Now, last point that we really have to focus in on. So CrowdStrike's current TEV to LTM revenue is 18.1 times. If you look at the last 21 quarters, basically since they've been public, their average TEV to LTM revenue, excluding the high and low, is 33.3 times. So why did we go at 9.5? Let's open up the note here. Very important to look at the details. If you look at all of the comps, you take an average, you get 9.7 times. If you exclude the high and the low, you get 9.5 times. Now, when I did the analysis of CrowdStrike's own multiples, the all-time low was 10.1. So by going with a 9.5 times multiple, we're in line with what the comps are telling us, but also we're being super, super conservative. Ultimately, we never want to overpay for a stock, and this is going to help us with that. All right, DCF valuation. We ran 3 scenarios, bear, base, and bull, with the current model at base. Remember, future cash flows are discounted back to today to get to TEV, or total enterprise value. We strip out net debt to get to equity value. This company, CrowdStrike, is a leading player in the cybersecurity space with eye-popping growth, net cash of $2.6 billion. But after dropping from an all-time high of $398 to $250, almost 37% since the global tech outage, is it worth buying today? Wall Street has CrowdStrike at a median of $363 per share. That's a 40% discount. So what does our analysis show? Let's hop in the model. All right, DCF time. Woo woo. EBITDA less DNA gets us EBIT, less cash taxes gets us EBIT. We add back the DNA. We take into account operating working capital. Then we strip out CapEx. We get free cash flow to the firm. We take into account the terminal value. Remember, this is 9.5 times the terminal revenue. We take all of those cash flows to discount. We multiply them by the discount factor. We get the present value of cash flows. That leads us to the total enterprise value. We strip out debt. We add cash. We strip out non-controlling interest. We add associate investments. We get an intrinsic equity value of a little more than $81 billion. Divided by the current shares outstanding, we get a value of almost $333 per share. Compared to the recent close of $258.81, that's a 28.6% discount, which is a screaming buy rating. Remember, on Wall Street, if we have greater than 20% discount, that would be a buy. Okay, sensitivity and scenario analysis. We ran 50 different models by utilizing data tables. We sensitized revenue growth versus CapEx intensity and WACC versus the terminal multiple. Here were our findings. 0 out of 50, or 0% were a sell. 1 out of 50, or 2% were a hold. 49 out of 50, or 98%, showed a buy. We ran each of the 3 scenarios equally weighted, and we got a weighted average value of $333. That's a 28.7% discount. So what's the takeaway? Utilizing conservative assumptions, we show a buy rating for the stock across all 3 scenarios. Let's hop in the model. All right, so as I mentioned, green everywhere. It's like St. Patrick's Day. We see 98% of the scenarios show a buy rating. We even have the below the low end of the company's projected revenue growth guidance, and we still get over $300 per share. Even at a terminal multiple of 9x, which is below our current terminal multiple, we still get a buy. We only get one hold. And even in that case, it's still a 17.6% discount. All right, going to the scenario analysis, we equally weight the three scenarios, bear, base, and bull. And look, we even get more than a 20% discount in the bear case. So it's a buy across the board, bear, base, and bull. We get a weighted average of 333 bucks. All right, the wrap up. So Wall Street has CrowdStrike at a median of $363 with a high of 540, which is a 109% discount, and a low of 253, which is a 2% premium. While the stock is 50% below where it was only a few weeks ago, 390 versus 260, it's still up 4.8% year to date and 60% over the last year. You should seek the advice of an investment professional always. I don't know your individual financial situation, and this content's meant to educate. But it is important to note that I was so impressed by my findings of this analysis and the current valuation dislocation that I have started building a position in CrowdStrike. The company is a leader in cloud-based cybersecurity. While the global tech outage was a major screw-up, the company's quick response, acceptance of full responsibility, and positive feedback from its customers provides a rare opportunity to take advantage. Warren Buffett's famous for saying, "Buy when there's blood in the streets." And while he was referring to finding bargains when the market's in the tank, it also applies to individual companies as well. This stock has gone from about 390 to 260 in a matter of days. And if you believe 390 is a realistic return point, that's 50% upside from here. I am fully prepared for some volatility and bumps in the road, and I do not think this is going to be a quick return to the high 300s. But I do believe that this unfortunate event of a global tech outage provides a unique investing opportunity for those willing to weather the storm. Now remember, this is a well-known company. 42 analysts are covering it, and while many reduced their targets, all have the company trading at a significant discount to its intrinsic or true value. With a dominant position in an industry that is growing at a 10 to 14% CAGR, CrowdStrike is an incredible investment opportunity in the cybersecurity space. If you like this and want to see another tech stock valuation, check out my super microcomputer model here or my PayPal model here. And if you found this valuable, please share this with someone who you think would enjoy this. And as always, be relentless.